Bismillahirrahmanirrahim. Assalamu alaikum. Dear student, this is the practice video. We are doing the practice questions. I will try my best to explain this topic nicely, precisely, in a very short period of time because whoever is watching this video means exams are just so near. So I don't want to solve this question with you in, I would say, 30 to 40 minutes. I'll try to take very less time. I'll try my best, okay? So let's read the requirement first. Hmm. hmm. 20 marks question. Okay, let me change this. Okay, requirement 1, it says explain with supporting calculation the total additional tax payable by Samphire Limited. Total additional tax, but paid by whom? Only Samphire Limited. They are talking about a company. Explain with supporting calculation the total additional taxes payable by Samphire Limited. 4 marks. If Samphire Limited gives the computer to Noori, alternative 1. If Samphire Limited makes a loan of £1,500 to Noori and then writes off the loan on 6 April 2021, alternative 2. Alternative 1 with explanation and discussion gives you 4 marks. Alternative 2 with discussion and calculation gives you 6 marks. Okay. Then they are saying ignore VAT, calculate chargeable gain for Kelp Limited on the sale of lease on factory 1, 3 marks. Point 2. Explain with supporting calculations the amount of chargeable gains calculated in B1 which will remain liable to corporation tax if any, if Kelp Limited claims the maximum amount of rollover relief available, 7 marks. You need to explain with supporting calculation the amount of chargeable gain which you have computed in B1 which will remain liable for corporation tax if any, if Kelp goes for maximum rollover relief. So after, let's say, getting the rollover relief, what amount is still chargeable under corporation tax? You need to calculate that and explain also. The following least percentages are given. We have also been given indexation factors. Okay, let's read the question now. You should assume that today's date is 1st March 2023. Okay, Samphire Limited requires advice on the cost of gifting a computer or alternatively making a loan to one of its shareholder. So normally what happens, uh, shareholders must be, and then it should be obviously it should be logically this should be a closed company, because normally in closed companies such things they happen that we give loan to shareholders normally, but I've never seen an ordinary shareholder getting loan from a company. Samphire Limited requires advice on the cost of gifting a computer or alternatively making a loan to one of its shareholders. Kelp Limited has requested advice on tax implication of replacing a factory and acquiring a new warehouse. Okay. Noori on 75% of ordinary shares in Samphire Limited. So obviously, Samphire Limited is a close company for Noori. Has been a director of Samphire Limited for many years. So Noori has two status. One, he is a shareholder of this close company. Second, he is also the director of this company. He is employee of this company. Okay. Owns whole of the ordinary share capital of Kelp Limited. So logically, Kelp and Samphire both are close companies for Noori. Okay. Samphire Limited is a UK resident closed trading company which prepare accounts to 31st March annually. While either gift a computer to Noori on 6 April 2023 or make a loan to Noori on same date to allow him to purchase a computer. So either company is going to give him a gift or either the company will give him a loan and they will say go and buy the computer. Alternative 1, Samphire Limited gives the computer to Noori. And you need to know, you need to remember one thing. In alternative 1, actually we need to calculate the total cost for the company. Even in alternative 2, we need to calculate total cost, total tax, additional taxes, and total cost for the company. The computer was purchased by Samphire Limited in March 2021 for 2,600 and has a current market value of 1,500. The current market value of computer is 1500. Okay. Samphire Limited has purchased no other plant and machinery for several years. Written down value of the main pool on 6 April 2023 will be zero, nil. Okay. The sale proceed of the for the purpose of capital allowances will be nil. Noori private use of computer has been insignificant throughout Samphire Limited period of ownership. Now let us first discuss on alternative one. Now what is happening in alternative one? Basically, number one, this is a closed company. Number two, Noori is a shareholder as well as director of this company, means an employee of this company. Okay. Now, alternative one, what sort of discussion we need to tell our examiner? In alternative one, when Samphire Limited will be transferring this computer, obviously as gift to Noori, it will result in no balancing charge. There will be no balancing charge. Why? It will not result in any balancing charge because sale proceed is nil. Company is not charging anything. So there will be no balancing charge. The reason of not arising any balancing charge is the sale proceed is the written down allowance is zero and the sale proceed is also zero. So there is no sale proceed. So transferring the computer to Noori will not result in any balancing charge in the main pool. Okay. Another thing, what is that? We know one thing. It will not result in any balancing charge because there is no sale proceed. Then some of the student might be thinking why it is not resulting in the then balancing allowance. Wow. In main pool and special rate pool, balancing allowance cannot arise until unless entire company, entire business is sold. So no question of arising balancing allowance should come in your mind at this time period of time, because in main pool as well as in special rate pool, balancing allowance only arises when the entire business is sold, entire business is ceased. It is not happening here. We are just transferring the computer to the Noori and he's not giving us anything. So there will be no balancing charge because balancing charge can arise in main pool as well as in a special rate pool and at any time. Okay. So number one, there will be no balancing charge. I cleared why I did not go for the balancing allowance. Second, another very important point is the sale proceed is nil. Okay. Another very important point is from the perspective of Samphire Limited, look at the cost of purchase. Basically, due to special rule of 6000 special rule of chattel, it is an exempt disposal. So obviously no gain issue arises also. So one, it is not resulting in balancing charge. Second, with the perspective of Samphire Limited, we'll be discussing one more thing. Due to chattel's special rule of 6000, when your cost and sale proceed is less than equal to 6,000 pounds, then it results in no gain, no loss. So you'll be discussing that chattel as well. Third, now what is happening? Basically, Noori is also an employee of the company. If obviously Noori is an employee of the company as well. Now, when company gives 1500, the market value of the computer is 1500. When company gives computer as gift to the employee, then it is a obviously taxable. It is a taxable benefit for the Noori. Number one. Number two, it is a non-cash benefit. And on this non-cash benefit, which is 1500, employer, which is the company, will have to pay class 1A NIC. And class 1A NIC 13.8% is applicable. If we apply 13.8% on this, so class 1A NIC liability is going to be 207. Very important point. This 207 class 1A NIC is a deductible expense for the company. So it means that when company is going to deduct this 207 from their obviously profit, so it will result in tax saving. So 207 into 19%, there is going to be a 39 tax saving. Tax saving for the Samphire Limited will be 39. So which means that 207, which is class 1 ANIC, let's say payable by the Samphire Limited, and the tax saving is 39. So overall cost of additional taxes which Samphire Limited will be paying is 168 under alternative one. And what I have done for alternative one, I have already did the little bit drafting for you in order to save the time, because otherwise it is going to take a lot of time. This is class part A. Alternative 1, gift of computer to Noori. Transfer of computer to Noori does not result in a balancing charge. I've discussed this. I've also mentioned 6,000 Chatter rule. As Noori is also a director of the company, so taxable benefit class 1A NIC and this. Okay. Now let's go to alternative 2. Samphire Limited makes a loan to Noori. That is very interesting. Now, in alternative 2, what is happening? Basically, Samphire Limited is making a loan to Noori. On 6 April 2023, Samphire Limited will make an interest-free loan £1,500 to Noori. Samphire Limited writes off the loan on 6 April 2025. The first point which you, dear student, needs to discuss is in alternative 2, number 1, Noori is not the only employee of the company, he is also the shareholder of this closed company. Now, what is happening? In closed company, when company gives interest-free loan to, let's say, Noori, who is also a shareholder of the closed company, then this closed company will have to pay notional tax to HMRC. The notional tax is 32.5% of 1,500. Repeat, Samphire Limited will be paying notional tax of 32.5% to 32.5% of 1,500 to HMRC, and when company is going to write off this loan, then amount notional tax paid to HMRC will be refunded to Samphire Limited. So repeat, since Noori is not the only employee of a company, he is also a shareholder of closed company. So when closed company gives 1,500 as loan to Noori, then organization will have to pay notional tax of 32.5% of the 1,500. Second, when company will write off this loan, then this notional tax charge will be repaid to the company. Another thing, when company is going to write off this loan, it will be treated as dividend payment, and on dividend payment, no corporation tax issues they will arise. One more thing, since the amount of the loan, interest-free loan is just 1,500, which is far more less than £10,000. So obviously it results in no taxable benefit. So 1,500 loan is not resulting in any taxable benefit. Obviously, the reason being is it is lower than the £10,000. Beneficial loan which is less than equal to £10,000, it is exempt. So it is 1,500 is also exempt because of that 10,000 rule. So accordingly, company will not be paying any class 1A NIC. But when company is going to write off this 1,500 loan, then it will be treated as taxable benefit. Then what happens? Why it will be treated as a taxable benefit when company writes off this loan? Because Noori is not only a shareholder of the company, he is also the employee of the company. So employer, company will have to now pay class 1 NIC. It will be treated as cash benefit now because you have written off the loan. So company will have to pay class 1 NIC 1,500 into 13.8, which is 207. Class 1 NIC will be paid by the employer. I'm not talking anything with respect to the employee because the question says additional taxes payable by the Samphire Limited. So we'll stick to ourselves with the Samphire Limited. So 1,500 into 13.8 will result in 207, but this time it is not class 1A NIC, it is class 1 NIC paid by the employer. On this 207, again company will be saving 19% tax, which is 39. So overall additional taxes is going to be same, which is 168. So, but a very important point is in alternative to, dear student, you need to discuss notional tax charge of 32.5%, number one. Second, you need to discuss when company is going to write off, it will be treated as dividend income, so no tax implication comes on the corporation. Third, you need to mention the amount of the loan is less than £10,000, so it will result no taxable benefits, so no class 1A NIC. Fourth, you need to discuss when company is going to write off this loan, then organization will have to pay class 1A employer NIC on this 1,500. So again, the drafting is already done to save the time. Alternative to make a loan to Noori. Noori is also a shareholder, which means giving loan to Noori Samphire Limited needs to pay notional tax 32.5% of 1,500 to HMRC following the written off HMRC will pay this notional tax. Loan written off is treated as dividend payments, so no tax impact on company. Although the loan is interest free, still no taxable benefit because less than 10,000. However, a liability to class 1 NIC will arise on writing of the loan, as Noori is also an employee of the company. Accordingly, Samphire will be paying 207 class 1 NIC and tax saving 39. So overall, additional tax is going to be same. Okay. Now let's see other part of the question. Kelp Limited disposal of lease on factory 1. What do we need to do? Calculate the chargeable gain. First, we need to calculate chargeable gain on factory 1. Kelp Limited is a UK resident trading company. Kelp Limited was assigned a 48-year lease on a factory building, Factory 1, on 1st November 2016, for which it paid a premium of 1,65,000. Okay. Kelp Limited used Factory 1 in its trade until 30th April 2022. Very important point. Since when it was being rented to the tenant who are not connected with the company. Very important point. Basically, what is happening after 30th April 2022? This was given to the tenant. Means after 30th April 2022, this factory was used as an investment property. And on investment assets, basically you don't get any rollover relief. All the reliefs, they are available only on business assets. So it means that this factory was used in the trade for how many years? If you count from 1st November 2016 till 30th April 2022, you will get 5.5 years. So logically, this this factory building was used in the trade for 5.5 years. Out of how many years? The factory was sold on 1st November 2022. If you count the time period from 1st November 2016 till 1st November 2022, you will get exactly 6 years. 17, 18, 19, 20, 21 and 22. Exactly 6 years. So out of 6 years, only 5.5 years this building was used as business asset. And the last 6 months, this building was used as an investment property, and we don't get rollover relief on investment property. So rollover relief will be available, but according to 5.5 years out of 6. Okay. Sale. Okay. Now what else? Sale proceed is 2,06,000. Remaining time period is 42 years. Now what? Let us just simply calculate chargeable gain. Very easily we can calculate the chargeable gain. They have given us the lease percentages. 42 years at the time of disposal, it is 42 years. Initially it was 48 years, and in premium paid was 1,65,000. So let me just quickly show you the calculation of B1. Gain on the sale of lease. Gain on the sale of lease. Sale proceed is 2,06,000. Sale proceed is 2,06,000 less allowable cost. The premium paid is 1,65,000. Remaining 42 years percentage is 96.593 divided by 99.289. Dear student, you have to use a calculator. 1,65,000 multiplied by 96.593 divided by 99.289. It gives us 1,60,520. You will get unindexed gain. Unindexed gain. So 2,06,000 minus 160,520. It gives us 45,480. From this unindexed gain, we'll deduct the indexation allowance. Indexation allowance. Indexation allowance is applicable on 160520. They have given us the indexation factors. Obviously, after December 17, we don't get any indexation allowance, but we are not getting this is not for us because on August 2012 we did not have this lease factory building. The relevant indexation factor is this because we got this lease on November 16. So simply 1,60,520 into 0.047. 1,60,520. 160,520 into 0.047. I'm getting 7,544.44. So 7,544. Here comes the chargeable gain. Here comes the chargeable gain. So 45,480 minus 7,544. The chargeable gain is 37,936. The chargeable gain is 37,936. In B part 2, we need to explain how much remaining chargeable gain after claiming the rollover relief is still chargeable. After claiming the rollover relief. Okay. Kelp Limited acquisition of Factory 2. Now let me tell you one thing. Rollover relief is only available when you are acquiring a qualifying asset 1 year prior to the disposal and 3 years after the disposal. Repeat. Rollover relief is available when you are acquiring the qualifying asset 1 year before the prior to disposal and 3 years after the disposal. Another point which you need to discuss is, let me tell you, B.2. Gain remaining after claiming the maximum amount of rollover relief we need to discuss. The first point which you dear student need, I'm not solving B part 2, I'm just explaining. In B part 2, first point which you need to discuss is out of 6 years, this lease factory building was used in the business for 5.5 years. So point number 1, you will not get the entire chargeable gain 37,936 as rollover relief whatever happens. Reason, out of 6 years, last 6 months the factory was used as an investment property and so last 6 months they do not qualify for rollover relief, which means that the maximum rollover relief which could be available, maximum rollover relief which could be available, 37,936 into 5.5 upon 6. It comes to 34,775. It means, let's say Cab Limited has, for example, made qualifying asset purchases 1 year, let's say 1 year before the disposal and 3 years after, within the 3 years after the disposal. But still, the maximum rollover relief which could be available is 34,775. It cannot go beyond that. Okay. Now it means few more things. It means that how much maximum Kelp needs to reinvest in order to get the rollover relief for 34,775. The sale proceed is 206, which means that if Kelp Limited reinvest within the qualifying period, how much amount? Just multiply this with 5.5 upon 6. How much we are getting? We are getting 1,88,833. So within the qualifying period, if Kelp Limited reinvests 1,88,833, only in that case, Kelp will get the rollover relief of 34,775. Okay. Now let us see relevant qualifying purchases within the qualifying period. Kelp Limited acquired a factory building, Factory 2, from Samphire Limited on 1st May 2022. Immediately started to use in the trade. Very important point. Disposal took place on 1st November 22. So this acquisition is within 12 months prior to disposal or within 12 months prior to disposal. So definitely factory 2 purchases is the relevant purchases for rollover relief because it falls within the qualifying period, and qualifying period is 1 year before the disposal and 3 years after the disposal. So factory 2 actually falls in 12 months prior to the disposal. Within the 12 months prior to the disposal, Samphire Limited acquired factory 2 for 96,000. Okay, Kelp Limited paid 1,38,000 for factory 2. So the relevant cost for Kelp Limited is 1,38,000. Relevant cost for Kelp Limited is 1,38,000. Kelp Limited acquisition of warehouse. Kelp Limited will also acquire a warehouse from an unconnected company for 78,000 on 1st April 2023. This is also a qualifying purchases within the qualifying period. This is coming within 3 years after the disposal. Kelp Limited will occupy 70% of the warehouse for its own trade and will rent 30%. It means entire 78,000 of the warehouse is not qualifying for rollover relief. Only 70% of 78,000 will qualify for the rollover relief. Why? Because entire warehouse is not going to be used as business asset. Only 70% of this will be used as business asset. So we'll take 70% of this 78,000. If we take 70% of this 78,000, if we take 70% of this 78,000, it is coming 54,600, which means that 1,38,000 is the relevant acquisition. 54,600 is also the relevant acquisition for the rollover relief. So if I add 1,38,000 plus 54,600, I'm getting 1,92,600, which is exceeding the required amount of reinvestment. The required amount of reinvestment is this, and I found 1,92,600 reinvested amount within the qualifying period. So it means that entire 34,775 will be available as rollover relief out of 37,939, which means that remaining chargeable gain will be how much? 37,936 minus the relief, which is 34775. 37936 minus 34775. So still 3,161 is maximum. Still it is chargeable. So alternative 2, dear student, I tried my best to explain. I really appreciate if you please, after listening this video, you do the drafting of part 2, especially because part 1 drafting is already being done. I tried my best to completely discuss the entire question with you guys within a very short period of time, keeping in mind whoever is watching this lecture, obviously the exams are so near. So I don't want now my practice videos to be very, very long. Still, it is 28 minutes long, which is really long, I would say. And those that are watching this lecture, let's say on YouTube, I would appreciate if they do the drafting and put on my YouTube channel, and try to subscribe the channel as well, so that other students can get the benefit also. So simply, thank you very much watching this lecture. Have a nice life. Assalamu alaikum.